Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 30th of March. Let's dive into the week's top market news. Navigating geopolitical uncertainty, European market divergence, and the stagflationary threat. Last week highlighted a dynamic in European equity markets closely correlated with the evolution of geopolitical uncertainty, with particular reference to the conflict in the Middle East and its potential impacts on the trajectory of global economic growth. In this context of mitigated risk aversion, the Pan-European Stocks Europe 600 index recorded a fractional advance of 0.35% in local currency terms. Within the continental equity segment, however, marked heterogeneity was observed among the main indices. While the German DAX suffered a contraction of 0.29%, penalized by domestic macroeconomic prospects, the Italian FTSE/MIB outperformed with an appreciation of 1.26%. Similarly, the French CAC 40 and the British FTSE 100 closed the week in positive territory, registering increases of 0.47% and 0.49%, respectively. The macroeconomic picture is further rigidified by mounting inflationary pressures stemming from the energy price shock triggered by the hostilities in Iran. In this regard, the European Central Bank has assumed a cautious yet distinctly reactive monetary policy stance. President Christine Lagarde explicitly signaled the Frankfurt institution's readiness to intervene with an upward revision of interest rates at any future meeting, should price stability conditions require it. However, the board considers it premature to outline a predefined policy path, emphasizing the need to analytically assess the nature, magnitude, and persistence of these exogenous inflationary drivers. Lagarde herself issued a clear warning to operators, defining financial markets as excessively optimistic regarding the timeline for absorbing the economic impact of the conflict. On the leading indicators front, macroeconomic data reflect a deterioration in sentiment and a progressive slowdown of the European expansionary cycle. In Germany, the ifo Business Climate Index suffered a decline in March, settling at 86.4 points. Although the reading was marginally higher than consensus estimates, it represents the most depressed level since February 2025. The breakdown of the index highlights severe weakness in the future expectations component, heavily conditioned by fears of the asymmetrical repercussions the war could have on German output. In a partial counter-trend, the German manufacturing PMI calculated by S&P Global showed a sign of short-term resilience, rising to 51.7 points in March from 50.9 in the previous month. Broadening the analytical spectrum to the entire Eurozone, the S&P Global Composite PMI confirmed a general weakening of the economic environment, slipping to 50.5 points compared to 51.9 in February. This contractionary dynamic is corroborated by the decline in new orders, which returned to negative territory for the first time since last summer, and by the emergence of severe disruptions in global supply chains attributable to logistical tensions. The implications of this stagflationary scenario are inevitably reflected in the downward revisions of growth estimates formulated by supranational entities. The OECD proceeded with a decisive cut to its European economic forecasts for the 2026 fiscal year, pointing to the Middle Eastern conflict as the primary catalyst for a structural increase in operating costs and a simultaneous contraction in aggregate demand. The new OECD projections estimate Eurozone growth limited to 0.8% on an annual basis, a sharp decline from the previous 1.2% target. Similarly, the GDP estimate for the United Kingdom was revised downward from 1.2% to 0.7%. precisely in the British context. Data from the Office for National Statistics certified an unchanged annual inflation rate of 3% in February. It is imperative, however, for analysts and investors to consider the lag effect inherent in this measurement. The February data do not incorporate the upward shock to crude oil and natural gas prices resulting from the onset of hostilities in Iran, dated February 28. A resurgence of consumer price pressures is therefore expected in the readings of subsequent quarters. Now our insight into alternative markets. Private equity and M&A 2026. Scenario, trends, and strategies. The global and continental private equity market is going through a very fascinating, yet equally complex, transition phase. Looking at the macroeconomic scenario between 2025 and early 2026, we notice a decisive recovery in volumes. Globally, the value of buyout deals approached $904 billion, marking a notable 44% year-over-year increase. Exit operations have also started to run again, reaching $717 billion with a 47% growth. Europe did not just stand by. On the contrary, the total value of buyouts grew by about 10%, reaching $235 billion, while European exits outperformed with a 65% leap, arriving at $240 billion. However, there is an elephant in the room. Dry powder, meaning the capital raised by funds but not yet invested, has been stuck at a record $1.3 trillion for 3 years now, creating enormous pressure on general partners to close new deals. Shifting our lens to Italy, the landscape stands out for its strong resilience and a very peculiar dynamic. Our market recorded a 25% increase in the number of deals compared to 2024. The real driving force behind this growth is the lower mid-market. Transactions are almost entirely concentrated on target companies with an EBITDA of less than 10 million euros, proving that true value in Italy is hidden within excellent SMEs. The health of these companies is encouraging. The approximately 1,100 Italian companies currently backed by private equity funds show solid performance, with an average compound annual EBITDA growth rate (CGR) of 16% over the last 5 years. Obviously, not all sectors are moving at the same speed. Right now, capital is heavily flowing towards segments supported by long-term macro trends. We are talking about the tech sector, specifically software and IT services linked to AI integration, healthcare, driven by demographic dynamics, and energy, pushed by strict European regulations on ecological transition. Infrastructure and financial services are also performing well. Conversely, we are observing marked distress in sectors more tied to discretionary consumption cycles, such as consumer, retail, and the fashion and luxury segment, which continue to suffer the effects of residual inflation and consumer caution. Behind these surface numbers, however, the traditional private equity model is subjected to strong structural pressures that an investor must absolutely understand to protect their capital. Timelines have stretched. The average holding period, meaning the time a company remains in a fund's portfolio, has risen to 7 years, slowing down capital rotation. This has generated a liquidity crisis for final investors, with cash distributions remaining below 15% of net asset value for the 4th consecutive year, causing a cascading 16% drop in new fundraising. Furthermore, the era of easy money is over. Until 2010, an annual EBITDA growth of 5% was enough to generate excellent returns thanks to financial leverage and multiple expansion. Today, with higher interest rates, the minimum organic growth threshold required to achieve the same results has jumped to 12%. How can we act, then, to protect capital and navigate this scenario in 2026? The watchword is intentional value creation. We can no longer rely solely on financial engineering. In the capital allocation phase, it is crucial to discard generalist funds and reward teams with deep vertical specialization in leading sectors. Winning deals will be those where the initial due diligence identifies clear opportunities for operational transformation, prioritizing digitalization, data integration, and the transition toward lean and asset-light business models. Only in this way is it possible to generate real cash flows, which remain the only true guarantors of an investment's solidity.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.